Good morning, everyone. Thank you for joining this meeting. So it's been a turbulent month, a sharp sell-off in early August as concerns shifted from inflation risk to the risk of recession. The concerns were ignited by rising US unemployment, and then market volatility was accentuated by an unwinding of the yen carry trade. The presentation today will argue that recession risk is low, but central banks are nonetheless aiming to cut interest rates. This is positive for risk assets and explains a sharp recovery from the early August lows. Although markets have returned close to their peak levels, the outlook remains positive. So first of all, growth is intact. In the US, manufacturing production in July contracted by 0.3% month on month, but that is largely due to distortions from Hurricane Beryl, which subtracted 0.3% from production, and bigger than normal annual retooling shutdowns in the auto sector, which subtracted another 0.6% from output. These effects should be reversed in the August data. Meanwhile, on the retail sales side, core retail sales in the US increased on a 3-month-on-3-month rate of growth basis to an 8-month high of 4.9% annualized in July, suggesting that the US consumer remains in decent shape. And the US economy is led by the consumers. I'm going to be looking now at the US earnings report for the second quarter. It's actually very positive. Second quarter US earnings growth was positive, reinforcing that the overall profit cycle is continuing to recover. The consensus forecast for 2025 earnings have been nudging higher. With over 95% of S&P 500 companies having reported, the year-over-year earnings growth for the quarter was nearly 13% on revenue growth of more than 5%. Earnings growth improved from the 8% pace recorded in Q1 and above the consensus forecast of roughly 10% at the start of the quarter. Approximately 80% of companies exceeded earnings forecasts and 60% beat revenue forecast. 9 out of the 11 sectors posted positive year-on-year earnings growth for the quarter. And leadership seems to be shifting from technology with a broadening in earnings acceleration. The most important takeaway of the Q2 earnings season was the shift to more balanced profit growth across sectors. In fact, financials produced the best year-on-year earnings growth at nearly 21%, followed by the healthcare sector with 20%. Despite a moderation in its earnings growth, the technology sector remained among the fastest growing sectors. The earnings outlook remains positive given the sturdy US growth backdrop and imminent rate cuts by the Fed. Earnings growth for the S&P 500 is projected to moderate to roughly 6% in Q3 before re-accelerating in subsequent quarters. The dip in Q3 earnings growth reflects a slowing in the profit momentum of certain sectors facing tough year-on-year comparisons rather than signaling deteriorating economic prospects. And if we look at other regions around the world, and here we've taken an example of a highly cyclical economy, Japan. Japanese earnings are highly cyclical and leveraged to exports and global trade, and the outlook for Japan is indeed very strong. Consensus earnings are expected to grow by a healthy 8% over the next 12 months. Corporate profit margins in Japan are at a multi-decade high, highlighting the structural improvement in corporate sector performance. A further rise in margins is expected as the domestic economy gradually firms and global trade expands. Global exports were in the early stages of an upturn, recovering from the hangover that ensued after the pandemic-driven goods boom and the subsequent unwinding. So that unwinding has run its course, paving the way for a new upcycle in global goods production and global trade. So whilst the risk or the fears and concern have shifted from inflation to recession, I think it's still instructive to keep a close eye on inflation, particularly in the US, where it's been most stubborn. Excluding shelter, which has been one of the biggest problems in US inflation, core inflation has slowed to just 1.8% year on year, and on a 3-month annualized basis, it is running at minus 0.3%. In other words, there's been slight deflation over the last 3 months. As shelter continues to decelerate with market rents and the labor market softens, the overall core inflation rate could also fall below the Fed's 2% target. So there's been some really good research from MRB on what to expect from markets when the Federal Reserve begins cutting interest rates. So they've got tables going back to 1990 showing the 3-month and 6-month price returns for the US equity benchmark following the first rate cut in the Fed easing cycle, going back to 1990. Where the initiation of Fed easing was followed by the onset of a recession, i.e. July 1990, January 2001, and September 2007, stock prices were lower 3 and 6 months after the first rate cut. However, when the first Fed rate cut did not precede a recession, i.e. July 1995, September 1998, and July 2019, investors made money owning stocks in the following 3 and 6 month periods. So let's look at these figures. In the 3 months and 6 months after July 1995, when the Fed started easing policy, the returns were 6.6% and 12.9% respectively. In the 98 cycle, after 3 months, 17.6% gain, 26.5% gain after 6 months. 2019, respective gains over 3 and 6 months of 1.7% and 8.3%. The fears about a US recession are overblown, and the Fed is not behind the curve in addressing the softening in labor demand. Economic growth has cooled from the rapid pace of earlier quarters, but it is still a safe distance from stalling or contracting. And as we've heard many times before from MRB and also from others, much of the recent rise in the unemployment rate can be attributed to an immigration-driven increase in the labor supply rather than rising layoffs. So it's interesting to see which sectors actually benefit after the first rate cut in a continued growth environment. The key takeaways are as follows. The consumer staples, communication services, technology, and healthcare sectors led most frequently when looking at 3-month returns. Communication services produced the largest average margin of outperformance, followed by technology. Based on 6-month returns, the communication services and technology sectors outperformed most frequently after the first Fed rate cut. These sectors also produce the highest average margin of outperformance. So this has all been a healthy correction. And this is nice research again from MRB, should be in the podcast. Importantly, and I quote, recent market action will help extend and possibly strengthen the global economic expansion, i.e. a healthy correction. Developments in the past month or two are conducive to better growth ahead. Why? Bond yields and policy rate expectations are far lower. Froth has largely been expunged from risk asset markets, and central banks are more dovish. The setback provides an opportunity for those who might have been lightly positioned in risk assets to enter into the market. Apropos the yen carry trade unwind, the Bank of Japan has already pulled a U-turn on its newfound hawkishness. The Bank of Japan Deputy Governor Shinichi Uchida's statement was blunt. The bank will not raise its policy interest rate when financial and capital markets are unstable. Another bout of asset inflation risk on looms. Such statements by the BOJ open the door to equity bulls to take on more risk. And this is the conclusion. In other words, when the dust settles after this bout of turbulence, bond yields will be much lower than before. The pressure on central banks to ease will have increased, or in the case of the Bank of Japan, to stop hiking. Risk asset prices will be on the margin less expensive, and the already positive backdrop for global corporate profits will have been further boosted as a consequence of lower borrowing rates. Moreover, crude oil prices have remained soft, which will be supportive of corporate activity and economic growth. The US November election is expected to take on increasing importance starting in September this month, but election years are normally positive for equity markets. The outlook remains positive for global equities and risk assets, and we've got a similar positive outlook from Alpine Macro and Capital Economics. Time is running out, but I just want to let you know this from Capital Economics. Their forecast, we think US big tech sectors will lead the way again before too long, but the other sectors and markets elsewhere will also notch up strong gains. Their dollar-based equity forecasts between now and the end of 2025, the leader, the US with 36%, emerging market Asia 27%, Europe 20%, the world excluding US 19%.
So if we just get stuck in on the local side, so firstly, if we just dial back to end of last week, it was termed by the Bureau of Economic Research as the quote-unquote calm before the storm, since the only statistic that was reported was the PPI. However, this week we find ourselves in the thick of it, with multiple macro statistics as well as indicators that came out. So when we consider what I'm going to be talking about today, it'll be the macro info as well as an earnings update for one of our OIM local holdings. On the macro side, we'll first start with the PPI figure for July 2024. Then we'll move on to the ABSA PMI for August. Following that, we'll move on to the Q2 GDP growth statistic for South Africa. So if we look at PPI, the figure for July came out last week by Stats SA. It's currently sitting at 4.2% versus a 4.6% statistic in June. This indicates that factory gate prices have increased, however, at a slower pace than before. The stat was lower than expected, which overall is positive news for the inflation outlook. Moving on to the ABSA PMI figure for August. So the seasonally adjusted ABSA PMI, or Purchasing Managers Index, declined back to contractionary territory, decreasing by 8.8 points to 43.6 in August, down from a stat of 52.4 in July. If we look at 2024 overall so far, this is the 5th month out of 8 for the year where the reading has been in contractionary territory, which reflects high volatility in the sector during a year of political uncertainty, high but slowing inflation, higher borrowing costs, and sluggish global as well as domestic demand, which hasn't been strong enough to fuel a sustained rebound in production, well, not just yet. Then if we look at the Q2 GDP growth stat for South Africa, so first we'll start on the supply side of the economy. So you can see that the SA economy grew by 0.4%, following a revised 0% growth in Q1, which came after an initial, well, the revised stat came after an initial contraction of 0.1%. The largest contributors to the growth were the finance, real estate, and business services industries, adding 0.3% to the economic growth of the country. And then if we look at the other side of the coin, in terms of underperformers, we've got transport, communication, and storage, which saw the largest decline, decreasing by 2.2%. And they were followed by agriculture and the mining industries. And sorry, just to note off there, I forgot to mention that in terms of contributors, finance, real estate, and business services were the greatest contributors, but they were actually followed by the trade, manufacturing, gas, water, and electricity industries. Then if we move on to the demand side of the economy, household and government expenditure both increased during the period. Electricity supplies also helped out a lot when it comes to household consumption. Overall, we could say that the stage has been set. Electricity availability has improved over the past year. More companies will be able to operate with less interruptions, and inflation also remains within the target band of 3 to 6%. Business environment seems upbeat. With interest rate cuts imminent, business sentiment should hopefully improve. More trade and activity is expected in the general economy, which should support overall growth in the local market.